Dear learners, welcome to Business Accounting course. In today's lecture, we are going to discuss about bookkeeping. In that, we are going to focus on single entry system, double entry system, and accounting cycle. First of all, let us look into what is bookkeeping. Bookkeeping, often called record keeping, is a part of accounting that records transactions and business events in the form of journal entries in the accounting system. In other words, bookkeeping means by which data is entered into the accounting system, either physically or electronically. This can either be done manually, like journal and ledger, and then, or it can be done electronically through a computer system, like using the programs like QuickBooks and Tally software. Different methods or types of accounting. One is single entry system. In single entry system of bookkeeping is where the transactions of the business affect only one account. It is only one account's value will be decreasing or increasing based on the transaction amount. That means in this particular account, only one aspect of a transaction is being recorded. Other aspect of a transaction is not recorded. Normally, if you take a transaction, there will be two aspects of a transaction, giving aspect and a receiving aspect. So either you're going to record only the receiving aspect or the giving aspect. That is called as single entry system. And it is an incomplete system of recording business transactions, because when you look at a transaction, you will not be able to you're not able to find out the full picture about the transaction. The business organization maintains only cash book and personal accounts of debtors and creditors. So the complete transactions of cannot be made. Recording of transactions cannot be made or cannot be completed, and the trial balance cannot be prepared with the help of single entry system of bookkeeping. And the other one, the system of recording the business transactions and bookkeeping is double entry system. Double entry system is an accounting system that records the effects of transactions and other events in at least two accounts with equal debits and credits. Sometimes it can be more than two also. In this system, every business transaction is having a twofold effect of benefits, as I said in the earlier, giving aspects and the receiving aspect. The recording is made on the basis of both these aspects. That is what is called as double entry system. So principles we follow in the double entry system. For every transaction, there are two aspects. One is called debit and the other one is called credit. The debit and credit aspects of transactions are to be identified based on the principles of double entry system of accounting. The moment whenever we use the word debit and credit, many people get afraid or sometimes kind of frightened, mainly if you are from a non-commerce background. But no need to worry. If you know the principles of double entry system, it's very easy for you to decide whether the particular transaction, particular account has to be debited or credited. So first of all, we will look into the classification of accounts. So there are different types of accounts have been classified. Normally there are major two accounts, that is called personal accounts and impersonal account. An impersonal account again is further classified as real accounts and nominal accounts. First of all, we look into the personal accounts. These are the accounts which are maintained for persons like individuals, like a natural human beings like you and me, and firms, companies, etc. And you can see there, further again, it is been classified as natural personal accounts like Kumar's account, Adam's account, Lakshmi's account, etc. When an account is being opened for a particular person, the natural human being is called as natural personal account. And the second one is called artificial personal account. These are the accounts which have been created by law, because all the companies or the enterprises or the firms, these are being created by the law. They come to the existence because of the law. So when you open an account in the name of a company or a firm or a school or college or club, those all are called as artificial personal account. And representative personal accounts. These accounts which are representing a certain person or a group of person directly or indirectly. Let's say that the wages are paid in advance to an employee. The wage prepaid account or prepaid wage account or prepaid salary account will be opened in the books of account. And this wage prepaid account is a representative personal account indirectly linked to a person. So example of representative personal accounts, you can see there in the example section, the last point, wages outstanding account, prepaid insurance account, advance instance paid, and accrued salaries, etc. These are the examples of representative personal account. So these accounts are representing somebody behind these accounts. Directly or indirectly, there are some persons to whom the wages or salary is being prepaid or is being outstanding, which has to be paid. Outstanding. So these are called as the representative personal accounts. And there is a rule of accounting for each and every accounts. This rule you have to remember if you want to pass the journal entry of personal account transactions. The rule is debit the receiver and credit the giver. So if the receiver amount your account you're going to write, then you have to write debit the receiver's account. And if the person whom is there in the transaction is the giver, okay, then you have to credit the giver account. So according to the above principle, the benefit receiver's account is to be debited and the benefit giver's account is to be credited. And the second classification of account is impersonal account. In that we have real account and nominal account. As you can see, the real accounts are kept for assets. So all assets of a firm which are tangible or intangible fall under the category of real accounts. And again further we can classify real account as tangible, which you can feel and touch and see. Those are the tangible account. For example, for tangible account is building account, machinery account, stock account, land account, etc. Similarly, intangible accounts are the accounts which are maintained for intangible assets, which you cannot see or feel or touch. And these are the accounts are, you can see the example below, goodwill or patent account or trading account, trademarks account. These are the examples of intangible real accounts. And what is the rule for real account? The moment you see a real account in a transaction, in a business transaction, you have to apply this rule. And the rule is debit what comes in and credit what goes out. So we decide based on the transaction. For example, the company is purchasing a machinery. So company is purchasing a machinery means machinery is coming in. So you have to debit the machinery account. In case company is selling the machinery, then machinery is going out. So you have to credit the machinery account. In this way, you have to apply the rule of real account. And the last account is called nominal account, which is being maintained for expenses, losses, incomes, and gains. So accounts which are related to expenses, losses, incomes, or gains are called as nominal accounts. And nominal accounts do not really exist in physical form, but behind every nominal account, money is involved. An example of nominal account, you can see purchase account, salary account, sales account, commission received account, etc. And the final result of all nominal account is either profit or loss, which is then transferred to the capital account. And the rule for nominal account is debit all expenses and losses, credit all incomes and gains. According to nominal account principle, expenses and losses are to be debited and all incomes and gains of the business have to be credited. Say for example, salary paid 5,000 and 5,000 is paid to the employees. So for the company, it's an expense. So salary account has to be debited. Now students, now after understanding what is bookkeeping and what are the different types of accounts, now we will look into what is the accounting cycle. how this accounting cycle takes place, where the transaction takes place and how it will be recorded and how the records are moved. You can see there. So accounting cycle is the various steps or stages of work or activity that we go through each year in accounting. You can see there, first of all, it will start with source document and then journals, ledger, then trial balance, then financial statements. The first step in accounting pro cycle is source documents. Documents such as cash slips, invoices, etc., that form the source of and serve as proof for a transaction. First of all, whenever you look into a particular document, maybe an invoice, you have sold the goods to a customer, you're going to prepare an invoice or you're going to give a cash slip, okay, cash memo. So that will become a source document. Once you get a source document, you're going to enter in the journals. You're going to prepare a journal entry and you're going to pass that in a journal entry. Either the account will be debited and another account will be credited for each transaction. And that data will be recorded chronologically or date order records of transactions entered into by a business. And the third step is preparation of ledger or T accounts. The ledger is grouping of all the accounts of a business, what is entered in the ledger. Once you enter the ledger, we're going to pass them, group them together. All the similar accounts will be grouped together and will be passed on to one single ledger. Say, for example, you have several sales transactions in a journal entry, in the journal book. So you take all the sales transactions and you're going to pass to sales book or sales account. That is called ledger. And the fourth step is trial balance. So you're going to prepare trial balance with all the balances, closing balances of all the ledgers. You might have prepared so many ledgers, okay, of your company. Maybe sales ledger, purchase ledger, expenses ledger, incomes ledgers. All those balances you're going to pass on to a statement called as trial balance. So trial balance is a sheet or a report displaying all the accounts of a business drawn up as a trial, okay, or test of whether the total of all the debit balances are equal to the credit balances. I would like to say one thing here. Trial balance will only check whether you have prepared your transactions arithmetically, accurately, and correctly, not whether you have followed all the accounting standards and principles of accounting. There can be still some errors, okay, but if you are arithmetically you are created, you are prepare your ledgers, then your trial balance will tally. That means your debit balances will be equal to credit balances. Moving on to the last stage is financial statements. Once you prepare your trial balance, you're going to prepare the financial statements. When I say financial statements, these are the reports of a business. And the purpose of financial statements is to show the reader the financial position of the company, where the company stands, what is their assets and what are their liabilities, and financial performance. The company has done operations for 1 year. They've done so much of hard work and so much effort is put. So what is the ultimate result or performance of the company? You look into through the trading account and profit and loss account or income statement, and then the cash flow statement of the company. So financial statements are usually prepared once a year and consist of an income statement, statement of changes in owner's equity, balance sheet, cash flow statement, and where needed, an auditor's report and other stating documents they have to prepare. With these students, and then before preparing the your financial statements, the final stage in the accounting cycle not shown above, which is called as closing of accounts or closing entries, which are to be done at the end of each year along with the production of the financial statements. All accounts has to be closed. Either it will be transferred to trading account or profit and loss account. And this involves closing out temporary accounts like incomes and expenses and transferring their balances through a profit account into the owner's equity or reserves. Hope you all understood the meaning of bookkeeping and then what do you mean by the systems of accounting, single entry system and double entry system, and then we are seeing types of accounts, and then we are seeing the stages or the process of accounting. With this, I'm going to stop the session. We're going to continue in the coming videos. We're going to discuss about the remaining part of the accounting syllabus. Thank you, dear learners.